Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week on Wall Street Wrap-Up, Saudi Arabia and Russia of OPEC Plus have agreed to cut 100,000 barrels of oil globally per day. How is that going to affect Europe? And more importantly, how will that affect the United States? And the stock market breaks a 3-week losing streak and ending the week in the positive. Is this a one-off or better times ahead? And have we reached peak inflation, or are there higher prices yet to come? I'm Andre Laborde. We've got all these stories and more on Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up for this Friday, September the 9th, 2022. I hope your week went well. Well, this week marked the passing of England's longest-serving monarch, Queen Elizabeth II. She was crowned in June of 1953 when her father, King George, died. Her son, Prince Charles, is now King Charles III. Queen Elizabeth was 96 years old. Well, coming up on the show, we're going to be talking with Jim Spiro. Now, Jim has close to 40 years of experience of managing money with over $2.8 billion of assets under management. He's been named top financial asset manager by Barron's Magazine, Forbes Magazine, and one of the top 400 financial advisors by Financial Times. Where does he see inflation, the stock market for the rest of 2022, and is a recession in the cards? Jim Spiro coming up. And how did the markets do this week? Well, the markets were closed for Labor Day, and all the major indexes were up, breaking a 3-week losing streak. All 11 S&P sectors ended higher today, and also for the week. And all 30 Dow stocks ended today positive. And this week, the Dow Jones ended at 32,151, which was up 2.6% for the week. And the S&P 500, well, they closed up 3.6% for the week. And the NASDAQ, they ended at 12,112, up over 4% for the week. Well, this week, Ruben Roy, who's a senior analyst at Stifel Investments, moved AMD to a buy with a new price target at $122 a share. Also this week, other analysts have moved stocks to new price targets. Bank of America named Citibank to a new price at $58 a share, and Morgan Stanley has put Disney as a buy with a $125 a share price target. Now, there's a saying in the stock market of sell in May and go away, and then buy it back after Labor Day. Since 1950, the average total returns for the S&P 500 ranked September as one of the worst months for the stock market. Now, last month for this year, we ended August down 3.5%. But on average, for the last 72 years, August usually had been ending flat. So we'll see in a couple of weeks if we're in the up position of the S&P 500 or not. But whether it is or whether it's not, it's a great segue into our guest this evening. Jim Spiro is Managing Director at Morgan Stanley. Forbes Magazine has picked him as the top asset manager for Louisiana, and he's here with us this evening. Hi, Jim. Welcome to Wall Street Wrap-Up.
Andre, I'm happy to be here. Good to see you.
Jim, this week, OPEC, and I should say maybe OPEC Plus, because that also includes Russia. They've decided, in Saudi Arabia, they've decided to cut 100,000 barrels of oil a day from the world supply. Well, I understand that's world supply. What do you think something like that will do to the economy of the United States?
Well, I don't think it's going to have a huge effect. I think that you must understand Saudi Arabia and Russia have some conjoining and also some conflicting agendas. Saudi Arabia obviously wants to maximize price so that they can try to shift their economy from being strictly one related to fossil fuels. As you know, Mohammed bin Salman has a game plan to try to make the economy much less reliant strictly on oil and natural gas. Vladimir Putin, in addition to wanting to maximize revenue, also is trying to finance his war. I think it's a reflection of the fact that demand is coming down, that they see global demand softening, they see economic weakness globally, and they're trying to get ahead of that. They recognize what happened 2.5 years ago, and they don't want to be remotely in a situation like that again. And the president went over there, whatever it was, 6, 8 weeks ago, and basically implored upon them to grow production. So obviously they have an economic consideration, but also a geopolitical consideration. And I thought it was an interesting statement that they basically subordinated the geopolitical consideration and the president's pleadings to simply an economic one.
Russia has shut down the Nord Stream 2 pipeline, which supplies natural gas to Europe. Now, what they're saying is because of maintenance problems, but I think most people believe that that's totally untrue. OPEC Plus cutting 100,000 barrels, in addition to Nord Stream, with manufacturing. You know, if it's going to be a cold winter coming up in Europe, will that be hurting manufacturing and supply chains that will slow the economy even more?
It could. Europe in general and Germany in particular are in particularly awkward positions with respect to the latter. Germany has basically shut down most of its nuclear capacity. There's some debate now about leaving the last couple of operating nuke plants open. They basically have shut down the bulk of their coal capacity, and they put themselves in a position where they're extremely reliant on Russia for natural gas and oil, particularly with respect to natural gas. France and some of the other countries are not quite in that position, and they have more nuclear exposure and so forth. And if we had a cold winter over there, which I hope we do not, it could be very, very awkward. The offset to that is that due to efforts on the part of European countries transferring supplies amongst themselves, and also efforts on the part of U.S., Qatar, and Australia to get supplies in advance of the winter beyond what they would normally provide, Europe's tanks, if you will, are fairly close to where they'd like them to be going into the winter. But there's very, very little margin for error, and they're in a rough spot, and it's not something that's going to turn around very quickly. It's going to take a couple of years.
When your clients call you and ask you, what are your thoughts about investing in the energy sector, what do you tell them?
Look, there are some cyclical components that always influence the energy sector. The economic cycle hasn't been repealed. There'll be good times and bad times. And obviously, when there are good times, the demand for energy, particularly fossil fuels, since those are the ones on which we most rely in this country, the demand goes up, and there's an opportunity for those companies to make more money. And we're in a situation like that right now. I would also say that I tell them that, in my view, there is a secular headwind that is not going to go away. In fact, I think it's going to grow. And that is, rightly or wrongly, efforts on the part of the administration and actually many people globally to try to shift the country's emphasis and reliance upon fossil fuels more towards renewables. And there's still a lot of headwind against nuclear. Now, that may be abating in this country because our hand is being forced. But I don't think, independent of whether a person believes it's well-founded or poorly founded, I don't think the secular headwinds against energy-related companies are going to go away. I think they're only going to grow, independent of whether we're ahead of our skis in terms of the transition to renewables and so forth.
There was a report in the Wall Street Journal, I think this week, on how with this administration they have leased the fewest amount of offshore leases since the Harry Truman years.
That's correct.
And Harry Truman was ending in '52. That was before really offshore was even started, and they didn't even have. And that was before the U.S. government was even in charge of offshore leases. So
yeah, look, what you say is entirely true. And the current administration, and again, they're entitled to that point of view, but they have a philosophical view that's antithetical towards the exploration and development of fossil fuel resources in this country. And to some extent, they recognize they can't totally shut it down. But their view is that the more rapidly we try to transition away from fossil fuels, the better off the country will be, not only from an environmental standpoint, but from a national security standpoint. And only time will tell. But they have obviously adopted policies that are congruent to that. Witness the $370 billion embedded towards climate change efforts in the most recent piece of legislation, the Inflation Reduction Act. Realize what you just said with respect to leasing and the small amount of acreage made available, and realize also with respect to tax and regulatory policies that are not particularly solicitous towards the fossil fuel industry.
The Federal Reserve is going to be meeting soon this month about increasing the interest rates again. Yeah. And we've had we've had a couple of them with 75 basis points, 0.75%. What are your thoughts about with the next meeting and throughout the other two following? I don't think we have any more in October, but we've got September, November, and December.
True. There are 8 of them a year. The next one will be the 3rd week of this month. It's critical. I think the likelihood of the Federal Reserve, the Federal Open Market Committee, which is really the ruling entity, the likelihood of interest rates going up is 100%. I think the question is whether it's going to be 50 basis points or 75. That's tough to say. I think the Fed most recent data point was the jobs report, and it was pretty good. It was really kind of not too hot, not too cold. But I think given the harsh language, the resolute language that Chairman Powell used after the Jackson Hole confab, if you will, I think the only data point coming up is releases on inflation numbers next week that might dissuade him from 75 to 50. But I think the goal is they recognize they're well behind, and I think the goal is to get the federal funds rate to a point where they can bring inflation down. So I would think the weight of the evidence would argue more towards 75, but we'll only know in a couple of weeks.
In the late 1970s, 1979, 1980, when inflation was over 14%.
Yeah.
And the way the metrics that the Bureau of Labor Statistics and such were, and the Commerce Department, I should say, were measuring, that they changed it from the 1980s to the way they are now.
Yeah.
That if we had the same metrics on how to measure today inflation as they did in 1979, 1980, that inflation would be over 10%. What are your thoughts?
The Fed has a number of bases at which they look. The one the people hear about most in the paper is the CPI, the Consumer Price Index. But they also look at something called their Personal Consumption Expenditures Index, which they claim takes not only the same elements that you see in the CPI, but they believe it weights them more appropriately. And then they also like to look at something called Core CPI and Core Personal Consumption Expenditures Index, or indices, and those remove fuel or gas, if you will, and food. Now, a lot of people will say that's nuts. I don't know of anyone who can function without using gas, and nobody can function without eating. So that's kind of really a bizarre way to look at it. But the Fed looks at that, and they say the reason those two components should be removed is because they're too volatile to really give useful information.
This week, I was watching the CEO of Unilever was on. And for our viewers, I mean, Unilever is a multinational company that makes numerous products that you can buy at the grocery store.
Yeah.
He was asked about peak inflation, and he thought that peak inflation has not yet hit. Do you think we've already hit peak inflation and we're on the way down, or do you think we have more to go?
If I were a betting man in this country, I would say yes. In areas of Europe, particularly the UK, I would bet no. I would say yes because the economy is already slowing, and gas prices have come down rather sharply. Now, obviously, one twist or turn that could complicate that really in a matter of, overnight would be the Ukraine-Russia situation, and that's an ongoing one, and that will have meaningful impact. But food prices have come down some. Commodity prices, which obviously are crucial inputs to food prices, have come down fairly rapidly. Particularly they, versus highly elevated levels. There's still a lot of them are still equal or up on the year. Gas prices, as you know, natural gas and oil prices are still up on the year. But just seat of the pants, if I were a betting man, given how much I believe the economy is beginning to slow, yes, I think we've had peak inflation, and I think the Fed will do what it has to do to get us to that point and make sure we're at that point. And I think we are. And I think even at to the extent that they will take their dual mandate, which is full employment and price stability, I think they will be willing to push the unemployment rate up to try to make sure that inflation comes down.
Do you think we're in a recession now, or we're destined to be in a recession?
Well, recession has a denotative meaning and a connotative meaning. Denotatively, it's 2 consecutive quarters of negative GDP. And by that definition, we are in one now, the first and second quarters, and there were some anomalous reasons causing this, but using that technical meaning, yes, we are in a recession. I don't think that's nearly as important as the connotative one, which is how things feel. the palpable sense. You know, how do people feel out there? Are they in a good mood? Are they comfortable spending? Are they optimistic? Do they feel good about the situation they're in? Do they think the next year and the year after are going to be better or worse than this year? So independent of the denotation, which would say we are in a recession, connotatively, I would say it certainly has a lot of the feeling of one. Yes, I would.
For the last couple of years, the FOMC, and as you were talking about, the Federal Reserve, had close to zero interest rates.
Yeah.
But what a lot of people don't really come to think about a lot is that they were also buying bonds, and they were dumping money into the economy in addition to the low interest rates. Well, now that they're raising the interest rates of what we're just talking about, they're also going the opposite way of what's quantitative easing, which is buying bonds and putting money in. They're doing quantitative tightening, which is now taking the money out of the system. So by raising the rates and also taking money out of the system when the bonds either mature or they're just taking that cash out of the economy, do you think that it's too much?
Well, you raise a wonderful point, which is going on behind the scenes, about which many people don't know. On an on and off basis since 2008, but particularly since the pandemic, the Federal Reserve has been engaging in a program called quantitative easing, where basically they create reserves. People often call it printing money. They create reserves electronically, and they use those reserves to go out and buy mortgage-backed securities and treasury paper. I think you really want to go back to get an understanding of what's going on to the onset of the pandemic. The economy basically collapsed overnight. The Fed came out and did three things. One, they took their overnight interest rate, which is the federal funds rate, which controls short-term rates, and it's the rate from which just about everything else that people pay attention to flow: credit card rates, mortgage rates, CD rates, auto loan rates. They took that down to zero. The next thing they did was they said categorically, unlike banks in Europe, central banks in Europe and Japan and so forth, they would not introduce negative rates, where bizarre as it may seem, you actually get to pay the bank for the privilege of taking your money. It's sort of the financial equivalent of the Stockholm Syndrome. I've never understood it, but they got away with it. The third thing they did is they said, we are going to engage in quantitative easing. And by that, as I said earlier, they create money and they use it to drive down long-term interest rates. The Fed directly controls short rates, the federal funds rate. They don't directly control, but they can heavily influence long-term interest rates. And they did that to try to put a floor under the economy, to try to induce economic activity, and also, Andre, to try to aid the government in its enormous borrowing needs during the pandemic. They did that to the tune of about $4.5 trillion. So from 2008, they went from a balance sheet of $800 billion, all pristine treasuries, to, at its apex towards the end of last year, just shy of $9 trillion, so up whatever that is, 10 or 11-fold. In addition to increasing interest rates now, they are now, and on an accelerating basis, so it's more every couple of months, they are now not selling paper, but they are letting those maturities run off their balance sheet. And the totality of it, unless they get, weak in the knees, I've heard is that they're going to do over a couple of years about 2.5 to 3 trillion. I've seen estimates anywhere from 0.5 to 1.5 percentage points of, shall we say, latent federal funds rate increases that people aren't prepared for. They've only done this kind of quantitative tightening once. That was a couple of years ago, and the market squawked. And it should tighten monetary policy even more. That's correct, and it's a very good observation.
We're going to pick up right where we left off. If you're just joining us, we're talking with Jim Spiro. We're so happy to have him, friend of the show. He's the managing director at Morgan Stanley. We'll take a break, but don't go away because we are going to be right back. If you're just joining us, so happy to have Jim Spiro with us, Managing Director at Morgan Stanley. I remember there was a quote in James Carville, who ran the Bill Clinton campaign and was in the Clinton White House. He one time said that he was so surprised of the bond market, and he said when he comes back as reincarnated, he wants to come back as the bond market because it puts so much fear in the financial sector. The treasuries, the 2 years, the 5-year, the 10-year, the 30-year. Does the stock market follow the bond market, or does the bond market follow the stock market? Or why are bonds so important to where the stock market is going?
Well, to answer the first part of your question, historically the bond market has sort of led the stock market. There are times where that relationship isn't perfect, but it's historically been the case. As to why it's so important, look, this is a country that runs on money, and the stock market obviously has to be valued based on a variety of things. But leaving aside the obvious ones, a company's earnings, the company's product line, management, competitive advantages, and so forth, the willingness of people to buy stocks and the willingness of them to pay up or not for stocks is heavily influenced. I would say it's the chief influence by interest rates, by the cost of money, by the opportunity cost of being in the stock market. From 2008, basically until just about 2020, give or take a couple of little exceptions along the way, interest rates were at zero or very close to it. That's one of the reasons the stock market exploded, because there really weren't a lot of alternatives elsewhere. Now, with interest rates coming up, there are opportunities for people to say, hey, I don't need the vagaries that are inherent in the stock market. I'm not getting 1/8 or 1/4% on a treasury. I can get 3.5% on a 2-year treasury. That's not such a bad gig. Not pay any state income tax, put my head on the pillow, and know that it's good. So obviously the cost of credit, the level of interest rates, is a huge, huge factor that can be supportive to or a detractor from the stock market.
Jim, do you think, I mean, with your clients, you advise clients for whatever their reasons may be, whether it be for retirement or for something special that they want to buy at a later date. Do you invest in bonds? And also, I'm curious your thoughts of not just treasuries, but corporate bonds. And of course, you've got the grade A and you've got all the way, which is known as junk. This week in the paper, they were talking about how because of credit problems and some of high-grade corporate paper, that there may be some defaults, but you go, oh, but there's high yields. Do you advise your clients in the bond market?
Well, we have a large amount of exposure to bonds for most of our portfolios. Now, obviously, it's a function of the client's predilection for risk or lack thereof, investment goals, risk tolerance, net worth, all of those kinds of things. But as a general premise, most people, particularly as they age, don't have 100% of their money in the stock market. There are exceptions to every rule, so it's not a hard and fast rule, it's a generalization. And then with respect to the bond market, obviously, the more you step out on the ladder, so to speak, to get additional yield, as a general premise, sometimes there's a nugget that you've uncovered, but as a general premise, you're taking on incremental amounts of risk. We're in a strange situation right now where the bond market has really moved ahead of the Fed, and the yields on treasuries, particularly short-term treasuries, Andre, say 2 years and in my view, are particularly attractive. We are actually in an inversion where 2-year treasuries are paying more than 5, 10, or 30-year treasuries. Leaving aside, that's generally not a particularly good economic note for an investor in those things, and even shorter 1-year, 6-month, 3-month treasury bills. It's my view that you get a pretty doggone good bang for the buck and really not have to worry about much of anything. So we're open to any ideas in the corporate area, et cetera, but right now the treasuries really are quite attractive for most people, and that's an area that we're pursuing with vigor.
Jim, I know you talk to a lot of people throughout the day, whether they be clients and potential clients and such. And
you.
You're true. You're right. And when it comes to cryptocurrency, there have been some state and federal, I don't know about federal, but there have been some state fire and police pensions that have invested in the cryptocurrency areas. And well, with not only stocks being down and mutual funds being down, in addition to that, the crypto has really been taking a hit. Yeah. When your clients ask you, Jim, what do you think about putting cryptocurrency in our portfolio account for retirement or whatever, what do you tell them?
Well, I have two answers. One is a practical matter. The number of vehicles that are available to investment professionals like myself that are tradable, that are liquid, and so forth, that offer exposure to cryptocurrencies in a fairly direct, not a very sort of 50,000-foot down manner, for regulatory reasons, are quite limited at this point. But what I tell people, which is a reflection of my own views, is that I don't invest in things that I don't understand. or I certainly endeavor not to do that. I really try to make that a hard and fast rule. And I've spent not an insubstantial amount of time reading about these things. And the truth is, after all of that and listening to some folks, I must tell you there's an argument that they can serve as substitute currencies, and that's, for me, a fairly easy one, I think, to refute, and an argument that it serves as an attractive asset class. And I simply, frankly, don't understand them. Notwithstanding that I've read and had people try to explain them to me, I've never gotten what I would call a lucid explanation on them, or one that I find understandable to me. So as a consequence, I just steer clear of them. There are too many things that I think, for me, offer what I think are promising potential returns that I understand, that I have experience with in nearly 40 years of managing money professionally, and that generally guides my behavior.
Jim, we're out of time, but I sure hope you come back, my friend. Always
you invite me, I'll be here.
Deal. Thanks, Jim. Well, if you have a question about finance or a comment about the show, we would love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead for market information for next week. But first, what product was first sold by 3M on this day in 1930 that's both waterproof and transparent, and the company thinks, well, you know what, it may have some large possibilities? We've got that answer in just a moment. Well, what product was first sold by 3M on this day in 1930 that's both waterproof and transparent, and the company thinks it may have some large possibilities? Scotch tape. In the depths of the Depression, it was an immediate hit for penny-pinching Americans to use as a cheap tool for everything from resealing of food cans to helping torn fingernails heal. Scotch tape, 92 years old today. Well, finally, what would you endure to have and enjoy an unlimited supply of your favorite food? Well, it seems quite a lot, because 27% of those polls said that they would endure public speaking, also followed by thunder and lightning, then heights and even spiders and insects, just to enjoy what you enjoy eating. And what do you enjoy putting up with what I've just mentioned? Well, Americans poll said that they would love unlimited supplies of pizza, followed by fried chicken, pasta, and finally, cheese. I'm sure those in Wyoming love that. And next week on Wall Street Wrap-Up, we'll be talking with an economist and research fellow at the Heritage Foundation, Joel Griffith. We'll be talking about the newly passed Inflation Reduction Act that will be hiring over 87,000 new IRS agents and may give you greater chances of being audited. That's next week, economist from the Heritage Foundation, Joel Griffith. Well, as a reminder, we repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that's our show for this Friday, September the 9th, 2022. I hope you enjoyed it. My thanks to Jim Spiro from Morgan Stanley for joining us this evening. Always, though, it's you. We appreciate you for allowing us into your homes tonight. So remember, follow us on all the social media, on Facebook and YouTube, on Twitter, and WYES.org. So have a great weekend ahead and a productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.